The stock market is arguably the greatest wealth creation tool ever invented, but there are risks. So rule number one for making money in the stock market is to protect the money that you already have. And the best way to do that is to never let a small loss become a big one. Our cardinal rule is to always sell if a stock drops 7% or more below what you paid for it. There are two reasons for this rule. First, if you buy a stock at the proper buy point as it breaks out of a chart pattern, but quickly reverses and falls more than 7% below the buy point, that usually means there's something wrong with the stock, the general market, or both. It's best to cut your losses at that point and protect yourself from a potentially even bigger decline. Second, if you take a 7% loss, you only need about an 8% gain to get back to break even. But if you let your losses grow, you can quickly find yourself in a deep hole that becomes increasingly difficult to climb out of. For example, if you take a 50% loss, you need a 100% gain just to get back to where you started. Sanderson Farms offers a good example of why this rule is so important. In December 2017, the stock jumped into a new buy zone from a cup-shaped base. Let's say you bought the stock at the 166.75 buy point. Just 2 weeks later, the stock reversed sharply on an earnings report, falling as much as 16% during the week. That triggered what should have been an automatic sell signal. But instead of selling immediately, many investors choose to hold because their pride and their ego get in the way and they don't want to admit they're wrong. Instead of protecting their money, they opt for a hold and hope strategy. So what happened next? The stock continued to head south for the next several months, falling as much as 42%. So instead of having to make up just around 8% for a 7% loss, investors who held now have to gain 67% just to get back to break even. Of course, Sanderson Farms may bounce back at some point, but why risk your hard-earned money as you hope for that to happen? Instead, proactively protect yourself from a potentially devastating loss by cutting those losses quickly. Note that the 7% sell rule is based on the price you paid for the stock. If you paid $100 a share and the price falls to $93, sell. But if the stock rises to $150, then pulls back 7% to around $140, that does not automatically trigger this rule. You're not sitting on a 7% loss in that case. You still have a 40% gain. When you do find yourself with a 7% loss, you may not know the cause of the stock's decline. It doesn't matter. You can figure that out later. The important thing is to protect your money by cutting your losses. That allows you to focus on capturing future profits rather than just hoping to recoup a potentially much larger loss.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.